Howdy, Jacob here. Today we're looking at Profire Energy in the energy equipment and services industry. 88 million market cap with a 74 million enterprise value. Very small company, founded in 2002. 8 PE, 1.5 price to book. Okay, return on invested capital and ROE and ROA all essentially the same. Must mean they don't have a lot of debt, if anything. That would make your ROE and ROIC the same. Revenue has grown from 35 million to 58 million, but has kind of gone all over the place. Where in 2016 they dropped 47%, 2019, 2020 dropped 14 and 45%. So very volatile revenue side, and it's not even due to, let's see, 2015, 2019. Yeah, maybe it's due to those acquisitions, but you'd think those be devastations, not acquisitions. So that's interesting to see. Gross margin side, pretty pretty consistent actually, 50% range. Operating margin, definitely pretty volatile, negative in a few years, as high as 25, 24%. Very impressive. Um, and then, yeah, like I said, ROIC has averaged about 9.4%, and same as ROE. So it looks like they haven't had debt, which we can see. No long term debt, no short term debt, and really 9 million in total liabilities off of 14 million very liquid assets on hand. So very healthy balance sheet. Cash flow statement is, I mean, it's kind of small, so I can't really see. The use of cash is really just buying back shares at this point. Not a lot of reinvesting back in themselves. So small company. I mean, they sell and install systems worldwide, it looks like, but it's just interesting that they're as small as they are and were founded as long ago as they were. So I don't know. This might be interesting. Let's do 3% revenue growth. Let's do market average, 15 PE. I'll probably do an average here. Let's do a pretty big range, 7 and 5. They buy back shares pretty solidly. They even buy 1% back. Yeah, I mean, they could be buying back 1% a year, no problem. Yeah, ooh, looks kind of ugly from that perspective. We're saying that needs to fall 75% to get a 15% return with these assumptions. I mean, these small companies are tough to look at too because you want a larger margin when you're looking at smaller companies. You want to make sure that they have insider ownership. I didn't look at that. Let's see what that looks like. So insider ownership, 25%. Okay, so good amount held by the board, which is a positive sign, meaning that in most cases they're likely going to do what's best for you as the shareholder, since they have stake in the business itself. Um, but yeah, I mean, I guess this does incorporate like the COVID years. So let's change it up. Let's do an even bigger range. Let's do 11 and 6. And yeah, it's still not there. I mean, I don't know. The company has been interesting where it's grown at 20% and then declined at 40%. So if you understand this business a lot better than I do, which probably isn't very hard, and you think that they can get these large rates of return, that would obviously procure a future PE that's a bit bigger. But for me right now, they've been around for a bit and are still just as small as they are. So I wonder if they're, really trying to push growth that much. But if they really are, they're definitely small enough to where they could produce 10% a year pretty easily. It's just whether that's what the companies can be able to do or not. And it just from the past 10 years or so of data, it just doesn't look like that's going to be the case or not. So yeah, interesting company. Hope you enjoyed the video and have a great rest of your day. Thank you.